Hey gang, wanted to shoot this video because I recently had a client that is wanting to do it. They see the math in it, definitely see the value, and he said, you know what, the jury's still out because one thing that scares us is the variable interest rate. The interest rate can rise, and that is true. With a home equity line of credit, it is a variable interest rate, and it can rise. Right now there's a lot of banks and credit unions that are offering introductory offers below prime. Some as low as 0.99 to 1.99, 2.99 until March of 2017. So there's different offers, but the purpose of this video is I wanted to show that even if the interest rates go up, which prime hasn't changed since August of 2008, but I truly do believe that it is going to change here in the very near future. And when they change, it's probably going to change by 0.25%. And it may not change again for the next year or the year after. It's going to be very slow and subtle changes. It's not going to be astronomical bumps. The economy just can't handle that right now. But I want to just play devil's advocate and say, you know what, let's say it does. Let's just say it goes crazy and the interest rates shoot through the roof. So this was a client of mine's specific scenario. They have $5,552 of monthly income coming in, and that's net. And they have about $2,456 of expenses. And again, that does include the home equity line of credit payment. So they're starting off with about a 266. They have less than perfect credit, so the interest rate for them, depending on what bank or credit union they go to, it doesn't matter to me. But I just wanted to play, again, devil's advocate and can start with a high interest rate of 4.25%. And let's say the interest rate changed 0.25% every year. And as you can see, their payoff term is 105 months. So about 9 years, a little less than 9 years actually, is how long it would take for them to pay off their home. And they actually just refinanced about a month ago to an FHA loan backwards to a 30-year term. So their option is stay where they're at, take 30 years to pay off their mortgage, take 18 years from now before they'll actually start paying more principal than they do interest, 6 years from now before they actually start affecting the principal heavily. So that's their option there, is to stay where they're at or just change their cash flow and pay their home off in 105 months. So that's just an interest rate increase of 0.25% every year. So I want you to watch this number. Again, it starts at 105 months. That's their payoff term. Let's say the interest rate jumps by a full percentage point. Now again, that 0.25% represents in 10 years 6.75% interest rate. So prime would have to be over 5% at that point in order for their interest rate to be at 6.75. So let's do 1 full point every single year. So that is some drastic changes that I just don't think will happen. But again, just play devil's advocate. So let's say their interest rate starts at 4.25 and jumps to 14.25%. It changed it by 3 months. So the payoff went from 105 months to 108 months. Now let's keep going. Most HELOCs cap out at 18%. But let's say this one jumped to 24.25%. And if you see the term here, it went to 113 months. So they go from 105 months if the interest rate changes by 0.25% every single year that they have it. Again, I don't think that's going to happen. But again, just to play devil's advocate, let's say the interest rate changes by 2% every single year and ignores federal law and goes above 18% to 24.25%, it only changed the total payoff term by 8 months. So granted, you don't want to pay 8 months more than you have to, but this is just an illustration to show you that interest rate does not dictate how much interest you pay. It's how quickly and effectively you pay that debt that will dictate how much interest you pay. Take care.